get downtown, traverse back and forth to the Blue Zone. My name is Wes Geisenberger. For those of you who don't know me, I help lead the HBAR Foundation's Sustainable Impact Fund. The HBAR Foundation is part of the Hedera ecosystem. Hedera is our very generous sponsor for this event. And Hedera is a public network. For those who don't know, it's a consortium of large enterprises across industry and geography with a governing council of Google, Tata, IBM, many other corporations that think about innovations in public ledgers a little bit differently than when you hear the word blockchain. These companies are thinking about it as a strategic innovation to get to enterprise adoption that also can scale to the individual. As part of the Sustainable Impact Fund, the HBAR Foundation is a grantee of Hedera itself, and our fund is focused on bringing the balance sheet of the planet to the public ledger. As part of our background and our mission to do so, we have 5 key goals. The first goal is making climate finance auditable, understanding the relationship of our investments to the outcomes. Of course, those outcomes need a methodology and a unit of account to get to that balance. That unit of account needs to be independently verified, and our third goal is scaling validation and verification, but that requires the digitization and open sourcing of methodologies. Those same methodologies and that independent verification audit is used on both the carbon markets, in the case of voluntary carbon offsets, as well as greenhouse gas accounting, which will be a major focus of our morning today. Our fourth goal is discovering a global climate asset price based on attributes, based on every single element of these assets that live on our balance sheet. And we want to use those assets to make ESG reporting credible, our fifth goal. And we want to think about that in the context of the regulations that exist today. Those are going to be major focuses for not just our goals as a fund, but as our goals to consider today. How do we use public ledgers, and how and where do they fit in the conversation today? Whether it's focusing on CSRD, our first panel of the day, understanding how we get to credible emissions reporting, value chain accounting. How do we think about bringing that beyond carbon emissions? Our second panel is going to focus on getting to quantitative outcomes. We have a fantastic set of speakers this morning from all different parts of the industry. We'll really think about technology, legal aspects. Our council member DLA Piper is here represented this morning. And we want to make sure that as we think about these innovative technologies, that they're not technology for technology's sake, but they're to achieve goals, whether they're in the context of the Conference of the Parties in Regulation or international agreements, but they work for real companies in a practical way. And our goals should really be today to understand how do we get to a practical implementation for something like reasonable assurance in carbon accounting. That may seem like a long way away, but the planning towards implementation needs to start now. As we think about the second half of the day today, that's very much going to focus on what is the infrastructure needed in the carbon markets. We had news this week on the first day of COP around an agreement on Article 6.4, focusing on the carbon market, helped created out of the Paris Agreement for the UN as a continuation of the voluntary carbon market. We also have Article 6.2, which we're hoping to hear some news on this week, or hopefully early next week, on how do we enable those host countries to have government-to-government agreements. We're going to have panels on what is the infrastructure required. How do we go from today's voluntary carbon market to a scaled international market and government-to-government contracts, bilateral agreements, ITMOs, those transfers of the international mitigation outcomes. Those conversations all require open source infrastructure, the same public methodologies, the proof that these carbon credits are real, that we understand their context, that they're rigorous, independently assured, that they're not being double counted somewhere in an inset versus a government-to-government agreement versus an offset that may exist in 6.4. These are all good conversations for public ledger technology, and we want to facilitate that discussion today, and we encourage you to engage. Even if it's not your area of expertise, or maybe there's opportunities to collaborate, not just from a technological perspective, but from different interdisciplinary areas. We have folks who come from the assurance background, the legal background, the technology backgrounds here. We have folks who've helped write laws who will be on our panels today. And we want to bring these conversations together. And we want to make sure that we're thinking about how we move forward in the context of Paris Agreement. You know, we just came out of another COP on biodiversity. There's going to be some biodiversity discussions. But how do we move to not just have a conversation separately on biodiversity or carbon, or technology or law, but bringing these conversations together and using technology as a substrate to help facilitate that discussion. And so I just encourage everyone to think about that, think about the opportunities we have in coming together, even though we're maybe in a different place than where we work on a day-to-day basis in Baku, and think about the innovation opportunity that we have as we all come together here for this conference. So as part of that, I want to start to introduce the first panel of today, and it'll be focused on value chain accounting. We have a fantastic set of speakers that I'm going to let Alec introduce. Alec is from DLA Piper. He is also a government negotiator on behalf of Mauritius. And I'll introduce Alec to the stage to introduce the first panel on value chain carbon accounting, and I ask everyone to give him a warm round of applause and make sure that we engage today in a way that supports all of our panelists, that helps support the entire week ahead. Thank you.
Thank you. No. Thank you very much. Thank you, Hedera, for this session, which I'm really looking forward to. I mean, I think we have an excellent panel with a long-standing experience in value chain accounting and all the reporting which needs to happen. And therefore, I would like to ask the panel to the floor. First of all, we have Nadja Picard, who's the partner at PwC in Germany. She's an auditor and tax advisor and is the global reporting leader with a focus on sustainability. Welcome, Nadja. Next up, we have also Kristen Sullivan. Kristen is an audit and assurance partner at Deloitte, and she is the Global Audit and Assurance Sustainability and Climate Service Lead at Deloitte. Welcome. Then we have Ali Karmali. He's a partner at KPMG in Canada, and he is the National ESG Data and Technology Leader, and is also the lead auditor for ESG for the banking sector. Welcome, Ali. And then we have, as a last panelist, as Steve Sauter. Steve Sauter is the Vice President and the Industry Principal at Workiva. Workiva, and I'm sure Steve will talk a little bit further about that, is of course a provider of climate reporting technology, working on tools to facilitate compliance, as well as enhancing the data accuracy, traceability, and interoperability across various value chains, which is of course very topical to what we're going to discuss now. So very interesting to hear all your views. So today's session, as you have seen, is has a title, Value Chain Accounting and CSRD, a path forward, and I think I have an eminent panel to see how we can do this, how do I plan to build it up. Of course, we really want to get an overview of the evolving landscape of value chain accounting in the context of the CSRD, so the European Corporate Sustainability Reporting Directive. As you know, this creates ever more complex reporting requirements, demands for transparency, and this session will really look into, first of all, what practical steps have these people and their companies implemented in order to make sure that they basically can do the job, that they can really come up with making those reasonable assurances across all the various complex value chains and legal realities and realities in all the jurisdictions which get involved. I think we'll also have to focus on some of the obstacles which still remain and what is available in order to overcome them, as well as see how auditing firms and technology firms really have to partner up in order to really fulfill this mandate of this ever complex reporting as, for instance, required by the CSRD. But maybe I want to start off with practical and the pathways which you already have implemented. Clearly, you're being asked to audit and work with companies on which have very extensive value chains, which have to do a lot of reporting. And so the question is, given the fact that you have these large companies who really have so much different connections with other companies in different countries, the fact that you need to really be able to scale all this value chain accounting, and then also, of course, in your role as auditors pronounce on that, how do you think can this best be streamlined, and what are the strategies you're currently using Maybe Nadia, I think you already have a lot of ideas on that.
Well, that's easy. Thank you for the question. So maybe a little bit of level setting. A lot of companies that we work with in Europe have done some sort of sustainability reporting because there is regulation for the listed companies out there already that was not well drafted. It was implemented in very differing ways. But most companies don't come to carbon accounting fully fresh. However, with CSRD and the actual requirement to have limited assurance first and then reasonable assurance on their data, it takes a whole new level. And companies are really challenged with full scope capacity building within their own entities. That ranges from processes and systems, something that we will be talking about more today, or this morning in this panel, to how does internal audit look at this? How do we integrate these questions and new processes into risk management? Who is responsible for what? Building whole new working groups that span from sustainability over finance, operations, technology, giving companies a whole new management challenge to actually properly implement sustainability disclosures at a investor grade quality into their companies. Because now we were just talking this morning, a lot of companies are now striving to get over the compliance hurdle with a lot of Excel in the mix. Yeah. We did a survey and that really revealed that of the 500 companies that we surveyed on the implementation of CSRD, 74% of people are still using spreadsheets. And you know what? I don't think that's going away anytime soon. There will always be some spreadsheets for some sort of information, but we'll probably see something like various sources of information depending on the topic sitting in various technology solutions coming together, and then you could probably talk even more intelligently about this than I can, coming together in somewhat a single source of truth, and then Workiva kicks in to put that in all sorts of reports at the end, right, or a similar type program. So that's the landscape, and that is what people are really bothered about. But to the second part of your question, the sustainability reporting really requires companies to drill down their supply chains and value chains because it goes downstream as well in terms of the disclosure requirements. And that is something that companies are totally not used to. Because currently what you do is you negotiate with suppliers about a product in a certain quality and a price. And you don't ask the question, and what's the CO2 balance? And by the way, what's the CO2 balance of the products that you use to create your product? So that adds a whole new level of diligence into the supply chain, and that is really cumbersome. An automotive producer said that they are engaging with their supply chain down 7 levels. 7 levels, right? It's not like the suppliers that you have sitting in your accounts payable. It's their suppliers, and so on. So, needless to say, to accumulate information in any type of reliable way, yeah, does require a whole different type of thinking, a whole different type of technology solutions and protocols, because what we're seeing right now and what the requirements are right now is a lot of allowable, because we can't do it otherwise, estimates and approximations. And maybe I stop here so I don't talk for half an hour and you just take us a little bit further.
No, but I think there's definitely a lot of things that we can take some time to go a bit deeper onto also, certainly also the questions from the audience later on. I think it's really interesting, I mean, because you very nicely indicated the challenge, just the scale of it. I mean, I can imagine one company, an Excel file with all possible data, but if you have to do it 7 levels down, so you get 7 different Excel files, it's probably not ideal, and I'm not sure how Deloitte has dealt with that challenge, and how have you been able to practically find pathways to help companies in that respect?
Yes. Well, good morning, and thank you again for the opportunity to be here. I'm so thrilled to be a part of this really fantastic panel. And again, as Nadia and I were speaking before the panel started, it's such an important framing of the way the sweeping regulation that we're seeing take shape in this first year and how we're seeing companies respond. I think even to the point of just stepping back and really thinking about and just being really clear about the purpose of regulation and standards, it's really this recognition, right, that sustainability, climate-related risks are business risks. And standards and regulations not just drive transparency and accountability, but help translate risk into measurable objectives. And that's what really allows the disclosure of performance and that insight into how management is really strengthening that capacity to deliver long-term value. It's messy in these early days, for sure. I think that as companies continue to really anchor on the risk profile and really think about how does that better understanding, that better sensing actually equip an organization to then take those meaningful steps. So again, risk is not contained to the four walls of an organization. And recognizing that risk manifests in different ways, require different types of data, requires different capabilities within an organization and even within that ecosystem of relationships and resources that an organization engages with. I think that really further strengthens that governance, the importance of effective governance, and actually helping to accelerate how an organization is not just preparing for external disclosure, but the data that underpins all of these activities is really at the heart of what we're really collectively trying to achieve here. So this infrastructure that requires the same level of and the same sort of dimensions as overall corporate reporting to truly provide insight to the market, assurance becomes absolutely critical to not just enable management to have that better understanding, that confidence in the business relevance of information to really inform choices and decision making, but to equip and provide external stakeholders the confidence that they can actually make choices around allocating capital to really drive that change. So I think there's just this whole sort of convergence of developments. And I think this idea that, regulation is absolutely critical, but not sufficient to truly deliver on these objectives.
No, thank you, Nick. I think that's very valid point. I mean, regulators can only do so much, but there needs to come in how it's been implemented, and then you're faced with challenges. But I do hear risk, uncertainty, data assurance, all these elements play a role, and I think also that's something where Ali with KPMG, you also have been dealing with, and you're also looking for some solutions in that area in order to really been able to take up that challenge. I'm happy to hear how you're doing it and how you're viewing it.
Yeah, thank you for having me, and it's a pleasure to be on this esteemed panel with my colleagues here. I'll start off by saying, Nadia and Kristen really articulated the context and the challenges very well. And they are extremely relevant to the challenges that our clients are facing. And I think about the intention of CSRD. The point of it is to really raise the level of equality in terms of importance about financial reporting and sustainability reporting. And so what that does is it creates more of a need for audit and assurance practices to not only sit over the reporting outputs, but the processes that go into that, for the intention of creating transparency. And transparency, in a broader sense, is going to drive the requirements for an organization to really challenge their business model, how they operate, what do they need to do in order to achieve that. And Kristen touched upon a number of those, and so did Nadia. They're going to effectively touch across people, process, data, and technology. In every one of these circumstances, the hope is that the organization modifies the way that it processes information, collects information, governs insights and decisions on capital planning, but also interactions with customers and communities in the value chain. And so it presents them with essentially a challenge. How do I change my organization so that not only are my products and services relevant to my consumers, but that my inputs to my process are as relevant to me in terms of how I use that, the impact that it has downstream and upstream. So now you have carbon as a currency being thought of in addition to a bottom line impact of your P&L. So what does that lead you to? Well, a number of particular outcomes could be discussed here, and I'm sure there are many. But one of the challenges is the how do you start to collect information that is quite inconsistent across the industry in a consistent way? And you do need a data collection process that is quite robust, that offers consistency, that outputs transparency, that enables collaboration, that allows for assurance or audit. And so that requires technology. Then that brings this conversation on the idea of distributed ledgers as being a underlying layer to pin down some of the several layers of information, whether it's on supply chain, whether it's on data quality KPI, whether it's on information lineage and processing and transformation augmentation of that information. So definitely an opportunity for information gathering, data consistency. And I think the other part that I think it's an important area to focus on is technology is often looked at as being quite a lever for efficiency. But to move too quick to technology without fixing the ecosystem of how that information is used, collected, and managed presents another risk in and of itself. And so you're doing yourself a disservice in the end state when you're trying to help your organization's sustainability profile change without information and practices that allow you to govern and stay consistent in the way that it's delivered. So I think working through the processes, understanding performance management workflow, sustainability reporting, thinking about governance of that information is going to be highly relevant. And tools like Workiva allow you to do that in the context of traceability, auditability, integration, and then downstream reporting impact.
Yeah, that sounds, you mentioned opportunity, and I think indeed Workiva is certainly working on to bring some of these solutions to the table. So I'm very eager to hear from Steve, how you holistically would deal with this challenge and how you kind of provide services to really allow those companies to achieve that level of data accuracy and other matters. So happy over to you, Steve.
Yeah, certainly. Thank you for the question, and thank you for the opportunity to speak. Being with PwC, Deloitte, and KPMG on a panel as a technology provider is an honor, so really appreciate the opportunity. The way that we think about companies engaging this kind of reporting, I liken it to, so by background, I'm in financial reporting. I began my career as an intern at PwC, as an auditor at Deloitte, and as a client of KPMG, actually, for most of my career, so I have some coverage there. And the way that I liken the exercise that reporting teams are going through right now, it's a little bit like trying to close the books for accounting purposes without an ERP. If you didn't have a general ledger, if you didn't have an ERP, and you had to figure out, like, what are my accruals and what's the financial statements going to look like, you'd probably have some invoices, you'd probably have some checks that you wrote, and then you'd probably be reaching out to various people asking them for little bits of information, and you'd kind of cobble that together through email, spreadsheets, or whatever. And then try to close the books, prepare financial statements, and whatever else management wanted. Well, imagine trying to do that and then giving that to an auditor, or giving that to your board, or heaven forbid, giving that to an investor or to a regulator. To me, that's the reality that teams have been facing, because all of this information has been sitting somewhere, but it's largely different in its class and nature. Sometimes you have an invoice, sometimes you might have an estimate. And teams are figuring out, how do I get this to the point where I can present this to a regulator or an investor, and especially an auditor, with confidence? And one of the things that we saw was so interesting is that with our customers at Workiva, we have a large footprint in SEC reporting and financial reporting in the United States. But the problems that the technology was solving for SEC reporting teams which is the ability to allow teams to collaborate on a single platform that's got audit trail, audit history, enables review, and everything else that you would want for that type of exercise. Those same problems existed with sustainability reporting. In fact, sustainability was the second solution that Workiva offered a long time ago, over 10 years ago. But then we saw this follow-on notion, which was, okay, well, sustainability teams have this exercise, financial reporting teams have this exercise over here, auditors are trying to get comfortable with all of it. Boy, how do we get a single platform that would talk to each other and enable all of this data to be shared while still have that single source of data, audit trail, history, everything that you would need? And to answer your question, that is the end state that Workiva is at right now, which is the only platform purpose-built to unify financial reporting, sustainability, audit, and risk. And I don't mean to make this a big Workiva commercial. Plenty of Workiva love here in the room, and that's wonderful. But to me, that looks past the real challenge that teams are facing and how this type of solution was born out of necessity for teams to have the confidence to do this kind of reporting. And Excel, back to your point, I actually loved what you said. Excel is everywhere, and it's not going away. And the reality is it isn't. Of course, we would certainly love for a lot of that information to make its way onto a platform like Workiva. But the reality is that it's not. And so how do you get a system and a platform that would allow you to go all the way from the end report all the way back to its source, whether that is an email or whether that is an invoice or whether that is a spreadsheet, where you can hand that off to an auditor, or you could hand that off to a regulator if that's the type of exercise that you're in, so that you could have that confidence in what you were reporting. I mean, that to me is really the ultimate end state to accomplish all of these objectives and to not burn out the people who are engaged in this work. Frankly, having been there in financial reporting, and that was kind of before, I'd say, like the heyday of sustainability, it's really difficult, really stressful, and candidly, I think doesn't attract very many people to the profession. And to me, the whole people side of it is a whole other element that we're not talking a lot about here, but I think is really hanging out there. How are people going to do this work?
I think there's probably a lot of people working at many different firms who would very happy with the kind of solutions that you would bring us. So I think this is really fascinating. Any immediate reactions on these points here, on specific strategies to deal with it?
So I think part of the problem really is that we focus on carbon for a second here. It doesn't sit in an invoice. It doesn't sit in a spreadsheet. It needs to get into a spreadsheet and on an invoice. And what is happening right now in carbon accounting and disclosures is we're looking at the greenhouse gas protocol as the one accepted methodology protocol out there. And due to the difficulties of finding the data, it allows for estimations and industry averages. That does not allow anybody to manage for carbon reduction in a company. Quick example, I'm a construction company because I look at a lot of houses, buildings out there, and I may have the choice to buy cement for my construction from company A at price X with a carbon balance of A, or at price Y with a carbon balance of B. How do I even get this information? So that requires the cement producer to have algorithms that allow them to calculate the carbon that sits on their product in a reliable manner between the different production sites. And then they need to make that information available to their customers. But unless the cement producer has that detailed ability to do it, and all cement producers in the rest of the world do it in the same way under the same algorithm, I don't get to that decision-making by the construction company to trade between price and carbon balance and make decisions, make real decarb management decisions on where do I buy my cement and who has the lowest carbon balance, right? And that is a real life example, right? So what is needed, not to replace the greenhouse gas protocol as a disclosure mechanism that makes companies responsible for their whole value chain, but to make the decisions easier and more reliable, as we get to the assurance angle in it, is two things. It's number one, an agreed upon algorithm on how to calculate how basically the CO2 molecules travel up and down the value chain on a product by product basis. Just a protocol that allows for that. And there are solutions out there, maybe we get to that. And two, the technology to allow these algorithms to travel transparently, safely, with internal controls and possible assurance on these algorithms so that they are broadly available to everybody and shareable. I think that is the challenge that we're talking here about, to really fix the carbon accounting problem and get to the incentive to really decarbonize in your value chain. Yeah. So that's really the issue that we're looking at here. And that is where the standard setters and maybe regulators need to come in to start pushing for these algorithms to be defined. And let's please not find algorithms that are interoperable, because that means just a big reconciliation exercise. Let's find algorithms that people do agree upon. Yeah. And then we need the community, technology, us here to help develop and spread the technology solutions that support the efficiency and ease of decarbonization to make these management decisions and ultimately better disclosures, more precise disclosures, more precise insights happen. So, sorry for that.
No, it's absolutely fascinating, Nadia. I think it's also goes a bit close to my terrain as well, because I mean, working on the greenhouse gas protocol, and then you say you have to replace it by an algorithm, and you have to supplement it. Sorry, apologies. Yeah, supplement it with an algorithm, because of course the basis is good, but we all know greenhouse gas protocol. I mean, there's the addendum. It's been from a while before, when all that value chain accounting wasn't necessarily. So I think we're looking for that supplement. But also I hear you saying like we should maybe avoid working with different systems and the interoperability. Ideally, we would have one algorithm on which everyone can agree on, so that we don't have that reconciliation exercise. Anybody wants to say like, okay, is that what we really need? Is that what the thing which is the most missing? And is it realistic that we're able to get such an algorithm, so that basically certainly would facilitate things? But do you see that feasible in the future? I don't know, anybody has views on that? Kristen, yeah?
Well, I think we're in such a state of maturity in the market. And so to the point of just sticking with, greenhouse gas emissions, the GHG protocol is a tremendously valuable tool. It's going through a refresh. There's a particular focus and prioritization around really moving beyond sort of the standardized, this is the scope 1, 2, and 3, and a recognition that, number one, many industries are operating in a much different context that require different options, different levers, different intervention opportunities that need to be defined by transparent methodologies. There's a very high degree of focus on putting some standardization around how you think about interventions throughout your supply chain to get beyond the estimations that at least give you that risk profile and understanding, and then moving into deeper understanding and access to data that can truly help you understand risk better and then make decisions. It is an evolution, and I think as we talk with a number of our clients, from the most mature that are investing in mass balance and various different environmental attributes that are really trying to push the needle, it's all about transparency. You don't have sort of an established protocol to work from. You're creating that, but that's a really, really exciting opportunity through the lens of, here's our basis of presentation. This is how we're looking at it. This is what we know. This is what we don't know. Standards allow for estimating, data uncertainty, measurement uncertainty. And that drives risk protection because you are transparently declaring and disclosing where the assumptions are, where the limitations are, but really what your objective is, and really working with your assurance provider to just get really clear and really transparent will get you to a place where you can obtain independent assurance while you're continuing to evolve in a better understanding and better confidence in that quality of data. So I think as we're seeing a lot of these developments mature, I think companies are really seeing, again, that idea that this isn't just a reporting exercise. This is actually a mechanism to get to managing your organization and the risks to your organization better.
Thanks so much, Chris. And I mean, I agree, transparency is absolutely key in that, and then that will also allow you to really make an assurance judgment on that. But that means sometimes, I guess, maybe Ali, if you could speak to that, is also when you have the big corporations and so on, they might have, because their value chain, they might be having different auditors, different systems. If they only have their own transparent system, which they've worked at, the issue of interoperability, at least for the foreseeable future, is not going to go away. But so I think probably we would need to have some type of partnerships or some to deal with those interfaces between various systems, various transparency systems, various types of data and in which technology they are. So how do you resolve that at KPMG? How do you deal with this?
I think it's certainly a challenge that everyone is trying to address today. But you know, if I look at the essence of understanding what CSRD is trying to achieve, and the idea that organizations now have to look at aspects of their business that are material to them, is the starting point. But even in that context, it's quite difficult to determine what is the accounting for materiality. I'll give you an example. We've talked about carbon, so I'll just sort of lift myself up from that for 1 second and think about an organization that sees a material impact to the production of an EV car. Well, if we think about the upstream impact to an EV car being the precious metals and the inputs to a battery coming from a mine, well, that mine might have an impact on the environment. It might have an impact on people in terms of health and safety. So if you start to think about, well, how do I assess and then quantify the impact of materiality from a supply chain for a product that is a certain distance or geographical location away where I don't have that data, you start to think about, well, what is the methodology? Then with that methodology, what is the right data? And then from that, do I have a better sense of whether that is material to me and my business? And then if I could get to that level, what can I do about it? And then how does my business change itself to make an impact so that doesn't happen again, so that you can talk to your suppliers about health and safety being a material function to your inputs that allows you to change your business. So there's like 3 or 4 steps there that require significant collaboration, significant consideration for materiality in data, and then a unique process for how do you quantify that when there isn't a protocol involved. So let's look at this and say, well, what that does to the current organization requires a significant amount of resource-intensive work. Someone's got to do this work. It requires a process. It requires a system. It requires a database. It requires governance and auditability. So organizations that are finding the challenge to manage the CSRD environment is a compliance exercise at first for the benefit of an impact opportunity later, is going to need technology. Now, the opportunity for technology is creating what might be the maturity window to say, this is a tough, if we take the step-by-step approach by looking at vendor solutions outside the context of a collaboration framework, a mutual collaboration framework about how data is collected and reviewed, so that if my competitor or even my supplier has the same materiality of inputs through the same mine that has instances of health and safety, well, maybe I can use that information from someone else. So if that sits on a distributed ledger that is public, that is transparent, and that is accepted, then I've just reduced a series of processes in my business to acquire that data to determine my materiality. And that materiality is a periodic exercise. It's not just a one-time endeavor. So I think having a mutual collaboration framework that's underpinned by a technology system that is distributed, public, and accessible allows us to start to deal with some of the bigger chunks of the value chain, and maybe in certain circumstances beyond value chain related impacts. And I think, as was mentioned by Kristen and Nadia, that carbon emissions is not beyond that. It's just a matter of figuring out how do we determine which protocol is well accepted, and then how from that protocol can we start to transparently share this information, and what level of assurance can we place on that where everyone can accept various processes of assurance, and start to sort of determine a more accurate system of data collection.
No, yeah, I think it's absolutely excellent. I think it just sets the scene perfectly, I think, for many other sessions we will have today in terms of probably creating the trust and making ESG reporting credible that we have on the basis of mutual recognition. But you wanted to react to that, Nadia?
No, I was just reacting to the word trust, right? And I think in a lot of the conversations that we have, we confuse assurance as a act of providing an opinion on a set of information or a process, and people think and want an opinion on an outcome almost, with, do we establish a system that I can trust? And that might be quite distinct and different. Excuse me. We're all very, very used to a system where we trust financial information and trust prices, right? I sell you something, you quote a price, I pay you cash. Cash is the means to make that transaction work, or virtual cash, credit cards, whatever. And we all trust that system, which, by the way, is why the system works, right? For carbon balances and molecules, we don't have that system yet, right? We don't have that inherent trust that if I tell you this is the carbon balance that sits on my product, this is trustworthy. I think that is something that we need to build, because that will then allow us to go back to assurance to a much lighter level in terms of assurance over sets of information, and not down to some of the requirements towards us, the Big Four, saying you have to assure that molecule that travels on a product, which is going to be virtually impossible, and if it's possible, it's going to be completely price prohibitive. So accepting a fair value measurement for carbon and building that system through regulation and acceptance will take us a lot further than the scream for the Big Four, and the auditing profession has to fix it by providing assurance on all sorts of things.
And just to add, I think that was a fantastic point. And just one example to bring what that is to life today, and has and can be almost an inspiration for other elements in the value chain, is SAF fuel. When we think about book and claim system, what we're trying to do is establish consensus. Just like Nadia mentioned, we do know very clearly what its scope 3 upstream and downstream emissions will be, because that's the essence of what the product is supposed to do, is to reduce that life cycle emission. So if we can get to that for other products and services, I think there's inspiration there to say, well, we can do it if we believe that there's a way to find a level of understanding about what that is. So I think there's inspiration for us.
Sure, I think that's I'm happy to hear a little bit of optimism that as long as we have realistic expectations and we know what the art of the possible is. But I hear across all of the interventions, and I think before we open it to the floor to questions, I think maybe, Steve, you could then see, given your experience in the past as well with the auditing firms, but then now working for a technology provider, how do you see this evolving in the future, and how will you as a technology provider and the auditing firms work together and create this level of mutual recognition that we need?
Well, I think, well, first off, let me say a +1 or +1,000 to what's been shared. Nadia, I think you talked about it first. The need for better tools and processes for decision making we think a lot at Workiva, we think a lot about disclosure and reporting because that's the business that we're in. But I'll never forget a conversation that I was having with one of our customers, and they said, you know, Steve, you talk so much about disclosure. In an ideal world, disclosure and auditing are the least important of my concerns. That should be the easy part. The problem is I'm getting so spun up right now on compliance with disclosure exercises, and I'm neglecting the important need for managing this, for optimizing the decision making. The disclosure doesn't do me any good if I don't have an ability to make decisions that are going to reduce my carbon footprint or allow me to evaluate alternatives and make informed decisions about, you know, this product or service versus another. Candidly, that was a little bit of an eye-opening kind of aha moment for me. And so again, I just want to reiterate just how much that resonated with me in the conversations that I'm having. I think the point that I'm, you know, the perspective that I have from auditing to financial reporting and now to working for a technology firm is that I don't think that this profession or this practice of corporate reporting and auditing in this world where we're now continuing to bring in additional sources of information, ironically, I don't think it's sustainable without the technology solutions we're talking about. And of course, I mean, that's somewhat of a self-interested thing to say. Obviously, I work for a technology company. But when we talk to firms and our customers about how they are approaching and thinking about this, technology is always part of the conversation, always. And in fact, you know, right now, you know, I think we did a recent survey. It was about 1,000 companies across North America, Europe, and Asia Pacific. And uniformly, 9% of them said that they were comfortable with their current technology solutions. They were comfortable with the current process that they have in order to get to this, what we call assured integrated reporting, the integrating of financial and sustainability reporting that is both ready for and has been subject to assurance. Assured integrated reporting, AIR is the abbreviation, and that's a term that we kind of coined, but I think kind of describes this. Only 9% of them said that they were ready for that. And ironically, the remaining 90% or so said that, hey, we plan to tackle this within the next 18 months. And so as I'm listening to this conversation, I'm now thinking to myself, okay, our technology firms such as Workiva and others, are we able to, do we have the solutions? Do we have the technology that's necessary for this type of work? And I think the answer is mostly yes, but we need to be there. We need to be keeping up with the evolution of all the things that we've been talking about. And that, to me, I think is a challenge that I see is, how do you have this disclosure and auditing exercise over here, this strong need for technology, and how does it all come together in what is a pretty rapid timeline for compliance, not just with these requirements, but the real decisions and the change that's going to need to be made for companies to meet their ambitious goals. You know, that's something that we're thinking about all the time.
No, that's great, and I think interesting food for thought, and I think I'm happy to there's some follow-up questions. I'm happy to chat with you because I now want to give the audience a chance to also ask what's on your mind or what questions you might have. Sure, sir. Maybe I'll give you the mic.
First of all, thank you very much for a great presentation. I'm also coming from your background, working in KPMG for 15 years, mostly in States, also a CPA. But I left this assurance career like a decade ago. And I remember even when we had standards which are not as comprehensive or requirements as not as comprehensive. Like, for example, there was a Dodd-Frank Act a decade ago about conflict minerals, was one of the part of that. And I remember we are like, as auditors, didn't know how to address that because you have to go all the way back through the supply chain, see where it was sourced, whether it was fair trade and things like that. And it was quite, we didn't have answer at the time. And now, and I really welcome, I'm now to the industry, IT industry, we are in payment processing company. And we also want to be, we want also be as environmental friendly as possible, but I also understand that even if we use EV, what happens on the other side of the grid, we don't know. Maybe there's a tons of oil and gas burned, and then it comes to us in the electricity, and we're portrayed as environmental friendly. So I just, because I've been out of the industry for quite a while, I wonder if these audit procedures, assurance protocols and things like that are up to date, and it's well automated, so the practitioners can actually get a reasonable assurance. And I like the point about the materiality. What is the materiality here is also another interesting question. So maybe it's a very general question, but just wanted to hear your opinion. Thank you very much.
Sure. Well, thank you. Thank you for that question. I think it emphasizes this framing of just using ESG or environmental social governance data is really, it's all about a data-driven way to understand long-term value, which brings in this recognition that there are trade-offs, there are dependencies around every choice an organization would make. So you're moving in one direction, but are you putting the right emphasis and prioritization on the trade-offs that come with that? And that's what is sort of become, the obligation of organizations to think holistically. I think the move towards professionalism in the discipline that organizations are putting around these priority material areas of impacts, risks, and opportunities to the business are only going to be of value and drive the trust that we were talking earlier if they are delivered in a way that can withstand independent assurance. And so you ask about the standards. We have a very busy landscape of a lot of actors in this ecosystem. And similar to how I think we're seeing the standards from a measurement and reporting evolve, we are seeing the standards from an attestation evolve. We saw just last month the finalization of a global sustainability assurance standard that was very intentionally designed to be used by a universe of providers so long as certain conditions are met. And there will be a complementary independence and ethics standard that will come out, I think it's next month, is what we hear, that will be very important to driving that confidence that the standards that are used to evaluate measurement and reporting and the disclosure of information is delivered following very explicit, transparent ethics, independence, quality control standards. And so similar to how we're moving quickly in the overall measurement and reporting space, the assurance providers are, this is a call to action for the assurance profession as well. We serve the public interest. And so we've got a very rapid, for standard setting perspective, a rapid progress that we are seeing. Again, it's going to take time for this whole machine and market infrastructure to really take shape and deliver what the market needs. But we're moving very rapidly.
I see a lot of agreement with all the others, but I think maybe Nadja, you want just to raise another point?
And I wanted to come back to your comment that people are getting bored with this whole disclosure and reporting stuff. Let's not forget what we're discussing here this week and next. We're talking a lot about financing. And financing needs information that is trustworthy, and that is typically disclosure and reporting, right? So how are the capital markets and other financing providers are going to make judgments on what is a worthy cause or not a worthy cause? And if we talk about green bonds or anything like that, where a sustainability progress angle is built into the conditions for financing, then it all depends on that reliable information of that corporation or the underlying cause that is made public for evaluation. So the decision-making is actually two ways. It's in the company, in the corporate, and it's by the stakeholders on the corporate. So that's, and it's all sitting on the same set of data at different frequencies and granularity, right? That's how I look at this. Materiality, you asked a question about materiality. Yeah. So as assurance providers, we always describe, or I say, it's sometimes like trying to nail pudding to the wall. If the criteria are set out on what the information is supposed to say, what it is supposed to be depicting, and how it's composed to tell that story, and the purpose of the information is clear, then it's clear what is materially wrong or not, right? we have, what, 150 years or something like that of exercising that and flexing our muscles in financial reporting. We're working on that for sustainability reporting, right? Because the true and fair view of the sustainability affairs of a company is not well defined yet. But that's also where, when we get to the carbon accounting, materiality of number of molecules, getting that right or wrong, is a really, really, really tough thing. So it's almost beyond assurance versus into full certification. And that is where it has to come away from certifying the outcome to certifying the process. There's no way anybody can really certify that it's the right number of molecules of CO2. We have to move to a world where it's about, it has the algorithm that is generally accepted being properly applied. That's where we have to get to. And then has the information of that certification or assurance traveled reliably up and down the value chain and the products. So
Yeah,
that's
and if I could just add, I think the emphasis on governance, I think we've talked about it throughout the conversation, but when you get down to what that conclusion of materiality, regardless of the criteria you're following, financial, impact, just the business relevance, I think this is just where the board of directors really plays this incredible role, and that's been emphasized in all of the regulation that's out there and the standards, that really anchoring on what is relevant to your business and to your stakeholders in a prioritized, structured, and well-evidenced manner is really that sort of ultimate threshold and criteria.
And Ali?
And no, just I think those are great points. I'd add, the other side of this coin is to stop the molecules from going down the supply chain. And so how do you do that? Well, offtake is another example. So if you can trap the molecules, if you can trap carbon between its production and then the supply chain's distribution network, then what you're effectively doing is accounting for the lowest amount of carbon emissions in your business. So an example would be if I'm producing a product at the expense of carbon, that I'm taking the exact same carbon out within my business at the very same time, maybe a carbon capture, maybe DAC, maybe CCUS. If I take my carbon out of the atmosphere as I'm producing it, I'm not sending it down the value chain, and I'm able to measure it more specifically, just like some of the DACs can today, effectively now reporting the most accurate carbon emissions, carbon capture, and then the carbon impact to what product would be sent down the value chain. So I think we're starting to really think differently about how do we contain the problem and we find new ways to address carbon in the meantime.
Ms. Stevens, anything you want to add as well from your perspective, just to close out the session?
Just only briefly, how interesting I find it that previously when I would buy a product, I want to buy it at the best possible price. And I don't care if that company's making money, if they're losing money, the price is the price. It's so interesting to me now, the phenomenon that, well, it's part of the price, but there are a whole lot of other considerations that go into it as well. That is a dramatically different paradigm that sustainability practitioners are going to think about. FP&A are going to have to think about. I mean, I don't hear a lot of people talking about FP&A, but to me, boy, that's just about as important of a partnership as ever, because now companies are going to need to evaluate not just the cost, but all these other factors that go into making the decision, and then how that's, of course, going to impact their companies as well, both their sustainability goals, profitability, and so forth. That is a fundamental change in the way and volume and type of information that's exchanged, and that, to me, I think is a challenge that's we're trying to tackle right now.
Oh, thank you very much to the panelists. It was a very rich debate. It was interesting to see how your sector looks at all these elements, and I'm taking away a lot of it, and I hope the audience as well. So can I just a round of applause for, thank you, Nadia, Kristen, Ali, and Stephen. Thank you.